Welcome back to Talk the Walk with me, Sarah Wong. I'm with Heiwai Tang, economics professor at the University of Hong Kong and director of Asia Global Institute. Welcome to the program, Professor. We're just talking about the Hong Kong's economic environment, and we just discussed the fresh GDP figures from the first quarter in Hong Kong. And you mentioned that the United States raised interest rates to curb surging inflation in this country, and that because of the dollar peg between Hong Kong dollar and the US dollar, that prompted a capital outflow from Hong Kong to the United States. And that led to the Hong Kong Monetary Authority to intervene for the first time since 2019 to prop up the Hong Kong dollar. Now, I wonder how much financial stress does that put on liquidity in Hong Kong, and what kind of implications and cascading effects should we be worried about, given what you just mentioned in part one, that the back and forth cash flow between Hong Kong and the mainland China is much freer now?
So I think the Hong Kong financial market is still very stable. Based on my observations, by looking at the numbers published by either the Hong Kong Monetary Authority or the Hong Kong government, there's no immediate concern about, the sustainability of the peg or, any massive capital outflows that would trigger even more instability in the financial market. So the kind of financial outflows that we have seen, if I were to speculate, is partly related to the high interest rate in the US right now compared to Hong Kong. And partly related to the weakened economy as we have seen in the last few months. But part of it is also related to the weakened Chinese economy together with the stock market performance in China as well as in Hong Kong. So it's basically the outcome of capital outflows is a mix of things. It's not directly related to the peg, and therefore there is any concern whether the peg should be reconsidered. And I'm sure this is not something that the Hong Kong Monetary Authority has to worry about in the near future. If you look at the actual amount of Hong Kong dollars spent in order to acquire US dollars to maintain the peg, is around 11 billion Hong Kong dollars compared to 300 billion Hong Kong dollars in the foreign reserve. I think the amount spent is very small, and we are not really talking about anything that would threaten the peg. And don't forget that there is always a range for the peg between Hong Kong dollars and the US dollars, and now we are really touching the 7.85 exchange rate for a while. So in the meantime, I think the recovery of the Hong Kong economy would attract businesses back, and it will attract some foreign talent to come back. The key, obviously, as many people have already mentioned, is to reopen the economy, get the economy back to normal, and hopefully in the near future open up the border to the rest of the world.
All right, but analysts and observers are also looking at the property market there, and they saw significant weakening of the activities in Hong Kong's property market, which is the least affordable home market, housing market in the world. And do you see a correlation there?
Yeah, so the housing problem in Hong Kong has been the most severe economic challenge for everyone. Whether you're expat, whether you are doing business here, you have to pay office rent, or whether you are just a student that you have to pay rent to stay in this expensive city. So since your first question is about competitiveness, I think solving the housing challenge is actually good for Hong Kong in the long run, in terms of allowing the economy to be more diversified, as well as attracting more foreign talent to come to Hong Kong. In the short run, which I think is what your question is all about, there have been quite a lot of uncertainty due to monetary tightening, due to uncertain COVID strategies in China, due to when Hong Kong can be reopened to the rest of the world, and therefore the expats and the foreign talents can come to Hong Kong again. So once this uncertainty is resolved, I think the housing market will grow again, if you ask me to guess. But we also need to remember for the last 10, 15 years, the housing price has been increasing by over 100 and 200%. So it has become, one of the priority for the current, but also the next Hong Kong government. I think there will be appreciation in housing prices, but I don't think the appreciation will be as much as what we have seen in the last 2 decades. And this kind of policy is consistent with what has prevailed in mainland. The mainland Chinese government also didn't want the housing market to be a barrier for economic transition and long-run development. So at the end of the day, we should start to think about housing products more like consumption products rather than investment products. Of course, there's investment value in it, but it would not like the kind of investment products that we have seen in the last 2 or 3 decades in Hong Kong.
Well, then how likely is a swift rebound of the housing market, do you think? Because you're quite certain that the housing market will grow after overcoming the short-term pains. And what kind of conditions need to be met before to facilitate a rebound of the housing market?
Yeah, so allow me to wear my hat as an economic professor, when it comes to predicting the price of a product, especially for durable products or investment products like a housing product. It all comes down to supply and demand. We all know the reason why house prices have been so high in Hong Kong is because of limited supply, both in the public housing sector and the private housing sector. We have heard, from the chief executive-elect, as well as the past chief executives, many times they had mentioned, the priority is to increase housing supply. I am confident that it will happen in the next few years. So higher supply would imply, downward pressure on house prices. But at the same time, given that the housing sector is so important for the Hong Kong economy, I don't think they will allow supply to increase by so much so that it would destabilize the housing market. And we are still a few years behind in terms of supplying housing units, both in the public and the private sector, in order to satisfy the local demand. If the Hong Kong economy become vibrant again after we find a way to deal with COVID, and after the border is reopened to the rest of the world, I think the demand in the short run will exceed supply, and therefore in the near future, I do expect that house prices will increase. But if you're asking me a long-run question, like 5 to 10 years, what will happen to the house price? I think there will be a better balance between supply and demand, and therefore the house price will be stabilized, kind of like Singapore. If you ask me, what would be the benchmark country to think about?
Housing is obviously the headache of several previous chief executives. And as you mentioned, Chief Executive-elect Mr. John Lee has vowed to get Hong Kong's economy back on track and focus primarily on livelihood issue that includes housing as well. And you've written extensively, I know, on transforming Hong Kong's monolithic trade-based economic model and the neoliberal market ideology, the non-interventionism. You've said now is the best time to introduce reforms. After Mr. Lee comes to office, under this particular macroeconomic environment, how do you think the incoming administration of Mr. Lee should translate its promise into effective policy?
So if you look at Mr. John Lee's election proposal, policy proposal, he mentioned 2 things repeatedly. Well, he mentioned a lot of things, but 2 things that caught my eyes as an economist. One agenda is to basically increase upward mobility, especially for the youth. The other, obviously, is to solve the housing problem, which is tightly linked to the ongoing inequality problem for Hong Kong. Well, not just ongoing, but something that has cursed Hong Kong's economic growth for many years. So if I were to guess, the next Hong Kong government compared to the previous 2 or 3 Hong Kong governments, there will be more policies that will try to harness inclusive growth. What do we mean by inclusive growth? The pie has to get larger, and on that, finance and all the Hong Kong's competitive advantage sectors will continue to play important roles. But at the same time, when the pie is getting bigger, we also have to think about how to distribute the pie. here I need to be very careful. I'm not proposing higher tax or some sort of redistribution from the rich to the poor, but we do have to think about as again what Mr. Johnny has repeatedly mentioned, intergeneration inequality. We have to deal with the kind of income inequality that arose due to asset ownership and between people who have asset and people who don't have asset, right? So a lot of the economic output as well as wealth were actually generated in the housing market in the last 2 or 3 decades, right? So we have to think about how to resolve inequality and how to bring back inclusive growth that we used to have before the 90s, right? So the kind of growth that continue to provide job opportunities and choices for young generation, regardless of their background. And only when we have that kind of economic structure with middle income jobs, which provide a lot of training and education opportunities, then we can think about a vibrant and resilient and inclusive Hong Kong that would resolve a lot of inequality issues and also reduce the tension between different parties in the city.
Heiwai, we have like a quick minute left, but I do want to ask you about your new appointment as the director of the Asia Global Institute. Now, I know that you're well-versed in international trade, cross-border investment, and export study. And I wonder, what new conversations do you wish to bring in public discourse from your vantage point in your new position?
So given that I only have 1 minute, I won't be able to tell you all 3 research agendas that I want AGI to be engaged in. But let me tell you just one thing. Given the geopolitical environment and given that everyone is talking about green economy and digital economic transformation, I think there are lots of opportunities together with challenges that Hong Kong needs to tackle. And obviously, we want Hong Kong to grasp all those opportunities. So therefore, through the opportunity at AGI, Asia Global Institute, I wish I can do more academic research to discuss, what kind of opportunities as well as challenges that will arise from those kind of economic transformation that would arise from the changing geopolitical landscape.
If you were to use one sentence to describe, what are some of the signs or movements in the local or global economy right now that you think deserve more attention and scrutiny to avoid a large-scale meltdown that we've seen a couple years ago to prevent history being repeated?
Obviously, the war in Europe is going to change the world permanently. Just 3 months ago, no one can imagine that there will be another kind of warfare that's looks so similar to the Second World War or the kind of wars that we have seen since the 70s. There will be continuous tension between different countries. Some of them have been ongoing tension, and some of them were triggered by the Ukrainian crisis. So the Ukrainian crisis will lead to more instability in the political landscape, but also in the global macroeconomic environment.
Heiwai Tang, Asia Global Institute Director and HKU Economics Professor, thank you very much for coming on Talk the Walk to share your analysis with us.
Thank you, Sarah.